Decoding political talk. What do politicians really mean when they talk about taxes? Welcome back to myfavoritecpa.com. My name is CPA Dan Hodges, and with the 2024 election in full swing, you've probably been hearing all kinds of promises and you've seen debate about taxes from the candidates. But what do these phrases and buzzwords actually mean for you and your finances? Today, we're going to decode some of the most common political jargon about taxes so that you know what's at stake when you hit the polls this November. So let's get started. Let's talk about the wealth tax. This is a very hot topic right now, especially when you hear candidates discussing ways to close the gap between the rich and the middle class. A wealth tax is very, very different than an income tax. As accountants, we might call it a balance sheet tax. This wealth tax would be levied on everything that someone subject to it owns. Things like stocks, property, luxury goods, instead of what they earn. Politicians that support this idea feel it's a great way to reduce inequality while targeting the ultra-rich, which is always a favorite of some political candidates. But keep in mind, before you get too excited, this is proposed that only the top 1% would be affected. And even then, there's a lot of debate over whether it's enforceable or whether it could lead to capital flight. And what's that? It's where wealthy individuals move their assets out of the country, overseas, to avoid taxation. This is something we hear almost every election. Cut the tax on middle class. But who exactly is the middle class? And how significant are these tax cuts really? Candidates often use the buzzwords middle class tax cuts as a way to appeal to the largest group of voters, but the definition of middle class can vary significantly. In some proposals, households earning under $400,000 of income are considered middle class, but in others, $100,000 is considered middle class as long as you're below that. What you're subject to or qualify for really depends on the lens of the specific plan. It's also quite important to remember and understand that these tax benefits and tax cuts can take many forms, ranging from dropping and reducing income tax rates, to increasing the standard deduction, to expanding tax credits like the child tax credit or even the earned income tax credit, which is usually focused on the poor. So let's just say you're a family of four earning $80,000. A middle class tax cut could save you anywhere from $500 to $2,000. It totally depends on the proposal. I guess it sounds great, but check the fine print because the devil is always in the details. And don't forget, this is politics, so a tax cut is often paid for by losing deductions in other places or losing tax credits. You have probably heard candidates debating the corporate tax rate, especially when it comes to economic growth and job creation. The corporate tax rate often refers to large companies and the percentage of those large companies' profits that go to the government. In the 2017 Tax Cuts and Jobs Act, the corporate tax rate was reduced from 35% to 21%, which proponents say that boosted business investment and created jobs. Now, critics will say that many companies simply use the tax cuts to buy back stock and reward shareholders instead of hiring workers or increasing wages. Here's the thing though, when political candidates are talking about raising or lowering corporate tax rates, they are discussing how businesses should be taxed, but the effects often trickle down directly to the consumers and employees, not to mention the investors, like your 401k, my 401k, dad's 401k and grandpa's 401k that are invested in big companies. So if you just think about this for a minute, higher tax rates could lead to higher prices because companies have to adjust to make up for it. Or on the flip side, I suppose it could lead to a decline in growth, maybe less funds to employ workers or to give out increases. On the flip side, I suppose lower corporate tax rates means more money in the pockets of the companies to reinvest, but it could mean less government money for public services. We have to balance these things out. This is a critical issue for anybody that has investments, whether it's stocks, real estate, or maybe even a family business. Capital gains taxes are levied on the profit that you make from selling an asset. If you have held an asset for over 1 year, then it is considered a long-term capital asset. And therefore, if you make money on that sale, it is considered a long-term capital gain, which is always taxed at a lower rate than your ordinary tax rates that would be applied to like your W-2. The lower capital gains rates under today's tax law could range between 0% and a maximum of 20%, depending on your income level. Short-term capital gains, that's something held for less than a year, that's always been taxed at your ordinary tax rate, which is usually much higher than the 0 to 20% rate. So when politicians start flapping their lips about raising capital gains taxes, they're typically referring to long-term capital gains. And the goal is often to make more tax on the backs of investors instead of making taxes on the backs of W-2 workers. When you talk about such increases, it could have some significant effects ranging from discouraging people from selling assets, but it also just means that investors might pay higher taxes, and that means less to invest. For middle-class investors, this could have big implications, whether it's on retirement savings or whether it's maybe on real estate that's been held and now it's for sale. What exactly is meant by tax loopholes? A tax loophole is essentially a provision in the tax code written into the law, and it allows an individual or a business to reduce their income subject to tax, therefore reducing their tax liability. Sometimes this does happen in ways that legislators did not intend. For example, some large corporations have been found to use offshore accounts to avoid paying U.S. taxes on foreign dollars invested in foreign profits. Politicians will often promise to close tax loopholes, but the reality is that is very tricky to do. For one thing, a lot of these politicians, they themselves benefit from these tax loopholes. I don't want to name names, but I think you may know who I'm talking about. Some tax loopholes do definitely benefit the wealthy, but so many benefit everyday working Americans, whether it's saving for retirement or mortgage interest deductions. It simply benefits so many people. So whenever you hear this dangerous term, tax loopholes, be sure to ask, which loopholes are you, my legislator, talking about? So as you can see, tax policy is often much more complicated than it sounds on the debate stage. Politicians use these phrases to get your attention and to communicate broad ideas, but it's crucial to dig deeper and understand, what does this really mean for you and your business? Whether we are talking about a wealth tax, middle-class tax cuts, corporate tax rate cuts, or what have you, it is important to know the implications and to help yourself make an informed decision for this election. And if you yourself are struggling with taxes or tax issues, check out what I have to offer on my website, www.myfavoritecpa.com.